Inflation is real and we are all starting to feel its effects, starting to feel that extra pressure from higher energy costs, food costs, mortgages, and then the dread of having to battle with your boss for a pay rise just so that you can get paid the same as you did last year. Inflation sucks, and the longer it goes on, the worse it gets, which is why you need to know what it is and what it isn't, how it affects different investments, and what you need to do to protect yourself from it. So, let's get on with it. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. To understand how we can protect ourselves from inflation, we first are going to need to understand how it works. Inflation, by definition, is the erosion of the purchasing power of money over time. As you can see here, over the last 20 years, the purchasing power of the dollar has been eroded by over 40%. And in theory, because we are talking about the purchasing power of currency, this should affect the prices of all goods and services and wages at the same time. But in reality, inflation does not work like this. Instead, it's like pouring honey into a jar. It initially piles up in one area, often starting in energy prices, and then slowly spreads out to adjacent areas of the economy before finally becoming embedded across all prices, although this process can take months or even years to fully filter through. It's easy to see its effects over 10 or 20 years, but from year to year it can be very hard to measure because it often gets distorted by other price changes. Think about it. Even in a world with no inflation, we would still expect prices to fluctuate. Some of these are from trends that happened over long periods of time through changing tastes and the relative value we place on certain goods and services. University or college education is a good example of this. Back in the 1970s, very few people expected to go to university. It was not seen as something that you had to do to get a good start in life. So we did not spend much on it in comparison with other things. But now it's gone from being a luxury to a necessity, which has pushed up demand, and we're also now willing to give up a much larger piece of our pie to get it because we now value it much more highly than we do other things. And these relative price changes would occur even if there was no overall inflation. And the same thing is true with jobs and wages. In theory, if inflation is eroding the purchasing power of currency, all wages should rise with inflation. In reality, we know that it does not happen evenly at first and will take months or years to fully embed. But over the long term, it should happen. That is, unless the economy is no longer valuing your job and skills in line with others. But again, these relative price variations would happen even if there was no inflation. But what makes inflation even harder to measure is the fact that some goods have prices that are very volatile in the short term. Food is a prime example of this. If there has been a bad harvest one year, the prices of certain foods may skyrocket, which makes it look like we've got really high inflation. But if we then get a good harvest next year, prices will fall back to where they were before, which then makes it look like we've got deflation. Energy is another big one. If there is a disruption to the supply of oil, either because of a war or OPEC reducing their supply, prices can shoot up rapidly. Or the opposite can happen. Just 2 years ago, during the pandemic, when we were all stuck at home and the demand for oil dropped off a cliff, the price almost went negative. At the time, this dramatic drop in prices suppressed headline inflation figures so much that we were bordering on deflation. But were we actually ever worried about deflation? Well, no, because we could clearly see that this was primarily driven by the extreme short-term price movement of oil, which we know would correct itself as soon as demand returned or supply reduced. Now, we're in the opposite situation. Demand has returned, but supply is restricted by the war in Ukraine, and this price spike in energy makes up almost a third of the headline inflation figures we are seeing. Usually, we only experience one of these extreme supply-side shocks at any time, but right now we are going through a perfect storm. Oil and gas supply is being impacted by the war in Ukraine, whilst high fertilizer prices and shipping costs have pushed up the prices of food. And then we have China, the factory of the world that has shut itself down because of their zero COVID policy. In short, we've been very, very unlucky. But as supply starts to come back online, we should expect to see prices fall, which will be deflationary. The headline rate of inflation that you'll read in UK newspapers at the moment is 10.1%. But that isn't really very helpful because it includes all of these short-term distortive price changes. So instead, what we need to do, and this is what economists look at, is use an inflation measure that strips out these highly volatile items to try and isolate the underlying broad level of inflation that is bedding in across the economy. And when we do that, we can see that core inflation is running at 6.2%. But even this figure will include the effects of short-term energy price rises because energy is involved in the production of all goods and services. And the consensus view is that once these supply side problems correct themselves over the next year or two, we should see inflation come down quite quickly. But if these higher prices linger around for too long and filter into the rest of the economy and eventually end up with higher wages, that could be a real problem. Yes, I said that right. Higher wages would be a big problem for the economy. As the saying goes, the cure for higher prices is higher prices. If prices keep on rising and wages don't go up, well, prices become unaffordable and demand has to fall, which means that prices will fall too. But if price rises feed through into higher wages, well, firstly, wages are very sticky. Once they go up, they never really come down. And secondly, if we get higher wages, it means that we can afford higher prices. So demand stays the same, which pushes prices up even higher, which pushes wages up even higher again. And this is what causes runaway inflation that can last decades and be devastating for our economy. And this is what economists are really scared about. Andrew Bailey, the head of the Bank of England, even went so far as to say that people should stop asking for pay rises as this risks turning short-term price spikes into runaway inflation. This was, of course, completely tone deaf, given that millions of people are struggling to pay bills at the moment, but he does have a point. So, how do we bring prices down? Well, prices are set by supply and demand. If demand is greater than supply, then prices will rise. But if supply is greater than demand, then prices will fall. Recently, supply has been constrained, which has pushed up prices. This will correct itself eventually, but maybe not fast enough to prevent runaway inflation. So we need to try and reduce demand. But unfortunately, just telling people to stop spending doesn't work. So central banks have to use the only tool that they have, to raise interest rates. Raising interest rates increases the cost of money, which increases costs for businesses and individuals, which should in turn reduce demand and push down prices as we all have less money to spend. I know it may seem mad that the government would want to increase costs for us at a time like this, but this genuinely is the better of two evils. If we don't do this, we may trigger runaway inflation that could ravage our economy for decades. But the danger with increasing interest rates is that if inflation is genuinely about to come down on its own, then we may be pushing the economy into an unnecessary recession. So much so that the market is now actually anticipating that central banks will be forced to start cutting rates during next year. So now we have a better understanding of how inflation works, how can we protect ourselves from it? Well, first and foremost, we should stay useful. If you have a set of skills that are useful to society, your value and what you are paid should rise with inflation over time. Unless, of course, society no longer values your skills as highly as it did before, which can happen whether there is inflation or not. So, stay useful. Invest in your skills and education, just as you are doing right now by subscribing to this channel. Cash. Inflation erodes the value of money, so you might think that holding cash is a bad thing, but it's not. You need to maintain an emergency fund of cash so that you can pay for any unexpected costs. It may piss you off that this cash is being eroded by inflation, but you need to remember that this cash gives you the security so that you can take more risk and target higher returns in other parts of your portfolio. But you need to make sure you get the balance right. Mortgages. Inflation is great for those with fixed rate mortgages. Let's say you have a fixed rate mortgage of 2% and inflation is at 6%. The real interest rate that you are paying is minus 4%, which means you are making 4% per year on that debt as its value is eroded over time. Whilst real mortgage rates stay negative or low, mathematically it does not make sense to pay it off, as long as you can find something else to invest in that will generate a higher return, which we will cover very shortly. But if you're trying to get a new mortgage right now, you'll notice that rates are well over 3% if you're in the UK, or even 5% if you're in the US. Whilst inflation stays high, you'd still be profiting on this debt. But if inflation drops back down to 2%, you won't be. However, when household expenses are rising rapidly, you may be better off instead building up a higher emergency fund to help manage fluctuations in your monthly cash flow before you then start to overpay on your mortgage. Because once you've overpaid a mortgage, you can't get that money back, but you can always commit any excess cash at a later stage once things calm down. So now, onto the big one. Should we be changing the way we're investing during periods of high inflation? To answer this question, we're going to need to dive into the data. Here we are looking at the real returns, so that's the return after adjusting for inflation, of different asset classes between 1972 and 2021, a period which captures the high inflationary environment of the 1970s and 80s. On the x-axis, we have the real average annual return, and on the y-axis, we have volatility, which is a measure of risk. Firstly, we can see that most of these asset classes have produced positive real returns over this period. And we can also see that there is a clear relationship between risk and return. The riskier the asset, the more return it has produced. But there are a few outliers here. Firstly, commodities, which have produced a negative real return over this period, which does make sense, as over time, commodities have become more abundant and easier to produce, which has reduced their price. Gold, on the other hand, has produced a positive return, but it's done so with a huge amount of risk, 3 times as much as other asset classes that have produced similar returns, which is why gold and other commodities should not be used as long-term drivers of return within a portfolio. Gold is not a productive asset. An ounce of gold will only ever be an ounce of gold. It does not pay out an income, and unlike stocks, it does not have a management team that is trying to turn it into 2 ounces of gold. So it's only really useful as a store of value or a tool for short-term speculation. But it's not very good for that either, because there are a huge number of factors that affect the price of gold other than inflation. As we can see here, the price of gold is actually less than it was 2 years ago, despite us experiencing record levels of inflation. So let's direct our attention back to these productive asset classes and see how they have fared during periods of extreme high inflation. The 1970s was one of the worst periods of inflation in US history, averaging 7.1% per year, which meant that over this period, the purchasing power of the dollar plummeted by 50%. Now, over this period, stocks and bonds were up a lot in nominal terms, but in real terms, they were down slightly, whilst property held its ground in the US and was up in the UK. The 1980s also saw really bad inflation, averaging at 5.5% per year. But during this period, stocks, bonds, and property all managed to produce pretty good real returns. There is no doubt that inflation is bad for investors, but this data suggests that even during the worst periods of prolonged inflation, investing in productive assets can, at the very least, maintain our purchasing power, if not, still continue to produce strong real returns. And this is what we should expect from productive assets. With property, owners can put up rents to offset the effects of inflation and higher interest rates. And if rents rise, then we would also expect house prices to rise too. For businesses, although inflation creates a lot of uncertainty, they should still be able to adjust their prices to counter the effects of inflation. And with bonds, although higher inflation and interest rates are bad for existing bonds, investors are then able to reinvest income and maturing bonds at new, higher rates of interest. So what should we take away from all this? Well, firstly, inflation sucks, big time. But no one knows exactly what is going to happen in the future. Perhaps inflation has already peaked, and we may see it go back down to normal levels over the next few years. Or runaway inflation could take hold and stick around for much longer. But if we are invested in a diversified portfolio of productive assets, even in the worst case scenario, we should be able to maintain our purchasing power. And best case, we still go on to see strong returns. And finally, I cannot stress how important diversification is here. As we know, not all asset prices will adjust to inflation simultaneously. So it's important we own assets in different classes, different sectors, and different geographies so that we can make sure we don't lag behind inflation for too long. If you have any questions about inflation, please do remember to leave them down in the comments. But otherwise, I hope you stay safe out there, and I'll see you in the next video.